also from my side. My name is Dejan Jovicevic. I'm the founder and CEO of Brutkasten, which is a media company for startups, innovation, digital economy. We're active in Austria and Germany. So we report about fintechs, about AI, about the topic that we're going to start talking about now. Our next block is all around data and AI that meet finance. Both aspects of this topic are super interesting for me, so it's my honor to host this panel. We'll have, first of all, one keynote and then a super interesting panel discussion. So I would like to call on stage Paolo Sironi, the author and IBM thought leader on fintechs and AI. Big round of applause for Paolo. I'm looking forward to your speech.
Thanks. No, I will this one. So thanks for having me here today. My name is Paolo Sironi. I'm a member of the IBM Industry Academy, which is a think tank that creates business conversations, bringing around the table the fintech community, the regulators, the bankers, the big tech companies as well. But what I want to make sure is that each and everybody of you is also part of this conversation, because Silicon Valley made a big mistake in understanding fintech and banking, as they did not understand the biology and the psychology of the real banking consumer, which is the topic of today. The title is The Knowledge Digitization Through Fintech Innovation. It's a different way of looking at the problem of AI, big data, and value for consumers. So this is the problem that we're facing today. You know Oliver and Hardy. Oliver is sick, basically is the bank, and the regulator comes with a quantitative easing trying to save the bank, but at the same time puts a cast on the leg. So the bank cannot move that much. The fintech come and want to pull the bank to make sure that the bank moves, so the bank cannot move. There is also legacy systems, part of that, they basically don't allow banks to be that dynamic as they should be. And the regulators come from time to time checking that the banks did what they're supposed to do. So checking the tails, being compliant. Clearly, this is not working anymore, right? So the problem of fintech, the problem that fintech has to solve is not just the problem of the bank, the problem of technology, the problem of legacy systems. It's a complex problem because it's an industry-wide and a consistent-wide problem. So if we don't understand exactly what the issue is, we won't be able to solve it. So what I want to do today with you is the following. You see, that's me, the only time where I didn't have a beard. So we have three little stories, okay, where we demystify some buzzwords and we requalify them in a proper way. The first buzzword is disruption. I'm going to tell you disruptive innovation is not important, as long as you don't have a way out of disruption. The second is digital. Digital is sexy, but guess what? It's a technology of the demand, what most of the revenues that banks can capture operate in an offer-driven business, is the pull-to-push gap. And third, unbundling, like fintech, creating very small solutions that attract customers is not a proper business model, because the internet shows that platforms ultimately win. So the question is how to create ecosystems that thrive on platforms. So we go into the first story, okay? Three stories. The first one is about disruption. So now, this is the Digital Disruption Report 2016 by Citibank, forecasting that by 2025, 50% of jobs in financial services will be gone. So guys sitting on this side of the room, move on the other side, because these jobs are gone. Just move. You won't have it. Now, the point is not if this is a good number, 50, 40, or 60. We know that financial services is already disrupted. It is going through a process of transformation. Is this the fault of the fintech, of blockchain, of artificial intelligence, of quantum computing? I don't think so. This morning, I was served an orange juice made of freshly squeezed margins. It all started in 2008 at the height of the global financial crisis, where banks started defaulting, so central bankers had to put a lot of money into the equation, so the quantitative easing, which lowered the interest rate to the limit and negative in some areas of the Eurozone, lifting the cost of capital. Basically, after the price for risk, there's no value for banks on the interest rate margins, whether you're a fintech, whether you're a bank. There's no value. So that's why banks started moving to the other direction, the intermediation margins made of payments, but you know that 5 years from now, most likely the margin will be very low because of instant payments, and wealth management, which is investment products and insurance products. However, there you have more digital disintermediation, you have a European regulation like the MiFID II, transparency principles, You see the passive investing coming to the market. So it's very difficult for banks and anybody that wants to become a financial services company to make money under these conditions. So the cost income of banks is not anymore sustainable. This is my point of view, where I start in the conversation with you today, but it's not just my point of view. I want to share with you the voice of some of the people I've been meeting, publicly or privately. These are public conversations, starting from Federico Dia at Paris FinTech Forum 2 years ago. Frederic is the CEO of Société Générale, and he told the audience, the real transformations today in financial services is a change from transactions to services, which, in my simple language, I spoke after him, means making money by selling products with embedded commissions, which are getting smaller and smaller and smaller, to packaging those products into a comprehensive mechanism called advice, largely speaking, that clients are happy to pay for transparently. This is what banks have to do. But then Sophia Merlot, the co-chief executive officer of BNP Paribas Wealth Management, she spoke after me and she said, we have asked the French customers if they want to pay for transparent advice, and they said, pas du tout. That means 9 here in Austria. Okay, got it? But she goes, it is in our DNA, we understand this is the transformation, we see the MiFID II is asking us to go through this change, so we want to do that. Now, I was sitting with Larry Fink, the CEO of BlackRock. This year opened quite a few conferences of BlackRock worldwide, 2 years ago on the Morningstar stage. And Larry told the audience that he wants 5 years from now, 30% of the revenues to come from solutions, so not product anymore. That means pushing technology to the front end, whatever the conversation is, institutional or retail or affluent, because in a sense, the financial services industry needs to discuss value in a different way in front of the client, because everything else in finance is commoditizing. So if fintech innovation is not the cause of disruption, what is fintech innovation? Well, fintech innovation really to succeed is the opportunity for banks to go through these transformations, a transformation from transactions to services. But in order to do that properly, we need to understand the different types of innovation, knowing that blockchain is not the conversation today because that is foundational innovation. So there are 2 types of innovations that should matter to you. The first one is disruptive innovation. The second one is sustaining innovation. Now, get this one straight because it's very important. Disruptive innovation is not about a better product. It's just about the client not understanding the previous value proposition, so willing to onboard on a solutions which typically is simpler, cheaper, so more convenience. But convenience means that the margins are low. So in order to make it happen, you need to become a very large volume business. Sustaining innovation instead means that you can create sustainable margins, therefore differentiating in front of the customers and being capable to move forward. Clayton Christensen, the proponent of the theory of innovation, explains that looking at 100 years of history, there might be a time when disruption occurs, when clients don't understand the value proposition. Somebody comes with a disruptive proposal and wins the market. But 10 years after, only those capable of moving into sustaining innovation again survived. The others disappeared. So this is an important concept for me, and I want to reiterate it with a cartoon, because I know that in most of the fintech conferences on social media, in the press, in a lot of books, a lot of people talk about disruption, but they don't serve you well, because they don't explain the way out of disruption. So now, we use this one, and you see the one with the beard now is me. That is 30 years ago at my birthday. So Dad came home with a present. That present was a CD player. Do you remember the CD player? You're older than me, so you were listening to music with a tape recorder, correct? So the CD player was 1,000 euros of today money. It's an example of sustaining innovation. I was happy to buy it. And every year, I was buying into more, like the equalizer, the subwoofer, the loudspeakers. You remember that? And I built the hi-fi that was sitting in my lounge. The last thing you bought were fiber optic cables. You remember them? To connect it and get knows what in terms of extra quality for listening to the music. Of course, I didn't spend that money. I saturated. So think about banks before 2008. They had a lot of products on their open architectures on display. They had bonds, structured bonds, funds, formula funds, target funds, subprime, mortgage-backed securities, futures, options, derivatives, so on and so forth. One day, the regulators, in the name of the consumers, stopped understanding the value proposition. Those products disappeared, largely speaking, from their shelves, but they were contributing to their margins by a large amount. That's why the cost income started plummeting. They were not capable of transforming in a way to make sure that cost income was working again. But this is exactly the time when I was there compelled with the fiber optic cables when Steve Jobs did something ingenious. He put iTunes on a Mac. I was telling this story to Steve Wozniak last year. He was smiling, not sure he was agreeing, but that's my interpretation of Apple. So what happens is that as I did not understand where to spend that money for my hi-fi with Pioneer, I bought the iPod whenever, wherever. Was the iPod better music than my hi-fi? You don't remember, do you? Was it better music? It was not better music, right? So it was not about the quality, but I got it. So now, think about robo-advisors. Is a robo-advisor better than a relationship manager, a family office, a private banker? I don't care. Maybe yes, maybe not. That's not the point for the consumer. The point is, if the consumer does not understand the existing value proposition, that is the only condition by which he can onboard into disruptive innovation. Otherwise, he might not do that. There is a strong attrition. But what matters to me is that if you go to an Apple store today, you don't find an iPod anymore. You find this. This is an example of sustaining innovation. This is how Apple made $250 billion cash in their coffers, moving out of disruptive innovation into an ecosystem that was planned and worked on the iPhone, which is a huge margin, 1,200 euros. We don't know the exact margin for Apple, but that's actually huge. That's how they make money. So what is the transformation for banks and for the ecosystem that enables them to move out of disruption and simplification into something else that differentiates the margins, that create sustainable margins for everybody? Well, it's very complex to say, but I think there is a company, and I, in brackets because it's a dangerous journey, that is trying to go through this transformation, changing an industry from its status quo straight into a different level without going through simplification. Can you mention one of these industries that want to change a traditional industry, bringing it up without going through disruption? That could be Tesla, because Tesla was not born by selling Fiat Pandas. I am Italian and I love the Fiat Pandas, but the Tesla was kind of an engaging car. But to me, this example matters because knowing that even sustaining innovation is risky, Tesla is based upon two things. An electrical engine, so which is the new engine that powers the digital platform of the bank of the future. And when you step into a Tesla, you have like a computer on your side, streaming analytics to you. To do what? To make you feel like and think you've got a better driving. So what is this for banks? And we'll get into the point of big data. This is artificial intelligence. Now, a lot of people made a mistake. They thought that artificial intelligence and big data is there for fintech and banks to understand the client, but who cares? It's not that they should not care understanding the client. But you know, banks were making money without understanding the clients for 70 years. The point that matters to me, we'll explain it in a second, is that first and foremost, you need to make sure you use big data and AI to help the client understand your value proposition, which on banking and finance is very complex to explain. Only when you do that, the client will feel engaged and will become effectively self-directed to buy into sustaining innovation type of products, where you can make margins instead of becoming an hyper volume that cannot sustain the competition against Alibaba, Tencent, or Amazon. So now, first message I said, disruptive innovation is not that important as long as, maybe you choose it, you don't have a way out of disruption. And you better know that now, because it takes time to build your way out. So you need to make sure that your architecture makes sense since day one. But everything needs to happen on digital more and more so. But there is a problem. Digital is a pull technology, while most of the revenues that comply with the sustaining innovation mechanism operate into a push economy. Now, you see this one, the frog is me, and I like to sit on the couch and I let IBM Watson take any decision for me, like artificial intelligence from my investment principles. But you see, the majority of people out there, in reality, they prefer to talk to a coach than sitting on a couch. I was discussing this with John Stein of Betterman 3 years ago. By the way, we met at, there was also Michael, you remember, in Geneva. And basically said, you cannot grow further if you do not plug the human element inside today, because the majority of the consumers are not willing to onboard for high margins on digital. That's what he did, a hybrid model, and he started growing the asset under management again. And this is due to the fact that the push and pull mechanism was misunderstood by a lot of people in FinTech, especially the Silicon Valley. It goes this way. You see that my accent, you heard it, right? I am Italian, but I live in Germany, now German. And every weekend, what do? My family lives in Milano. I live in Frankfurt. So I catch a flight and I go to Milano. And my role in the family is to do the grocery. So every Saturday morning, I go to the supermarket. And I want to be very fast. So what do I do in the supermarket? I start pulling from the shelves my bread, my pasta, my beers, right? And then I see an advertisement of George Clooney shampooing his beard with a different brand. I saw that you bought it as well because I see your beard is shining, right? Down there, raise the hand. The guy, yes, you're the guy with the beard, right? You bought it as well. Now, I love George Clooney, it's okay for me. So it's pushed to me. Procter & Gamble does a lot of marketing. But when I arrive at the cashier, I look inside the shopping trolley, and what do I find? That 95% of the things I bought are always the same. Think about it. The same semi-skimmed milk, the same type of beer and brand, so on and so forth. Why? Because grocery is a very and largely pull mechanism, is demand-driven. Now, Michael Mellingoff never said, Paolo, let's take a look at what is going on Amazon. What's going on Amazon? Nothing. You're all going there to buy one of my books, right? And then maybe you're pushed a different book. But you go there with a certain purpose. I was making the presentation of my fourth book, the pre-presentation before Davos in Hangzhou, where there is the head office of Alibaba. And the Alibaba guys, they told me themselves that 364 days of the year, the principle of Alibaba is extremely pull. Only one day out of 365 is push, which is 11/11. You saw what they did. $40 billion worth of sales for single day in 11/11. Because people go, because there may be a discount, and it's pushed to them. But the remaining of the year, people tend to start searching for a specific product, for a specific something, so on and so forth. But when it comes to investing, which I said is where in insurance, most of the revenues are concentrated right now, nobody out there goes on Google saying, is there an investment fund which is 30% stocks from the US, between 12 and 14 European stocks, up to 20% of stocks from China, but not those in Guangzhou because I am ESG. It doesn't really happen, okay? People tend to get into a conversation and need to basically make an investment decision which remunerates the relationship with a certain margin. And this is the reason why banks are configured this way, because rooted in the business model of banks that FinTech need to understand, otherwise that we hit the head on the wall, is the concept of the asymmetry of information. Let me explain to you the asymmetry of information with this cartoon. You know South Park? So South Park, this clip was on American television in 2009. I want you to listen to what happens. The little kid has some money to invest, goes to a bank to make a decision.
I got a $100 check from my grandma, and my dad said I need to put it in the bank so it can grow over the years.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
What's all gone?
The money in your account. It didn't do too well. It's gone.
What do you mean? I have $100.
Not anymore, you don't. Poof.
Well, what can I do to get back
I'm sorry, sir, but this line is for bank members only.
I just opened an account.
Do you have any money invested with this bank?
No, you just lost it all.
Then please stand aside for people who actually have money with us. Next, please.
Okay, so these things happen all in America, okay, not in Europe. But anyway, the key element here is that the little kid you saw, he does not understand finance. He does not understand banking. And it's not about information per se. He needs to get into a conversation somehow to make a financial decision. And what happens, for the good and for the bad, he trusts trust that conversation, and therefore he makes a decision, which is the reason why the essence of a digital strategy to be successful and sustainable is the digitization of knowledge, because knowledge is trust. If a financial institution or a large fintech or a challenger bank believes that the scope of their working journey is to digitize financial products, they will not go far beyond the VC money they spend on marketing. If they instead understand that the essence of banking is knowledge transfer, therefore they can digitize knowledge in order to make people comfortable in making financial decisions, they will be able to stay relevant and make money. Now, I know that when I use this word, the digitization of knowledge, you tell me, Paolo, go to university. Okay, next week I will be at NYU in New York for the presentation of my latest book on the financial market transparency theory. And I can go there and discuss about this. But I get to tell you, this is not about academia. This is about real life, or at least Hollywood. You know this movie? The Wolf of Wall Street. Okay, your age, the other guys that watch still Gone with the Wind and stuff, right? But you see, in this clip, Leonardo DiCaprio explains to his co-workers how to sell penny stocks on the phone. It's like selling financial products, right, or stuff for insurance on mobile today. We listen carefully to what happens in this clip.
Sorry, I appreciate the call. I really have to give this some thought and talk to my wife about it. Can I call you back?
They don't know, right? They gotta think about it, they gotta talk to their fucking wives or the fucking tooth fairy. Point is, it doesn't matter what the fuck they say. The only real objection that they have is that they don't trust you guys. And why should they trust you? I mean, look at you, you're a bunch of fucking sleazy salesmen, right? So,
I'm the only salesperson. Now, in between the various what happened, he said, the client does not know, even though he doesn't know, why doesn't he buy from you? Because he doesn't trust you. So the two words are knowledge and trust. If you can digitize knowledge, you can create the trust of your customers, and they can also operate on digital. People might think, therefore, that is very complicated, so we can stay with the human relationships where we are, right? Because it's more convenient. But you see, something is happening. Artificial intelligence is becoming more and more conversational. Only when and if AI will be completely, truly, and deeply conversational, this technology, mobile, will transform from being a pull technology into a push economy, and the circle is closed. For the time being, at some point, you need to create hybrid models because this has not happened, but it's starting to happen a bit at a time. And where is this supposed to happen? On platforms. So we said, disruptive innovation is not important if you don't have a way out of disruption. Second message, digital, mobile is a pull technology, demand-driven. Most of the banking and ultimately fintech offers that originate sustainable margins operate in a push economy, offer-driven business. Only when AI will be deeply and truly conversational, mobile will go from pull to push and the circle is closed. For the time being, you need to use AI to augment the capability of relationships at some point, otherwise you will not be able to break through sufficiently. Remember the story about Betterment hiring human advisors to continue to grow, otherwise the robo-advisory model will not have functioned. But now, this week, something happens. So this week, we are launching Breaking Banks Europe. You know, Breaking Banks is the #1 fintech podcast with Breaking, 7 million of audience in the world out of through 117 countries. So I'm happy to be co-host with Brett and some other guys on the Breaking Banks Europe, where we try to leverage the voice of the European fintech and community to make it more relevant on the world stage. But the breaking bank is also a funny concept, right? It's the idea basically that you can break banks, it started many years ago, by providing simple-minded and simpler solutions like any of your fintech that you'll be bringing on stage before my presentation. There is a problem here. I always tell my fintech friends, you cannot break a bank for the simple reason that a bank is already broken. It's like divided into different business units that do not stand together, right? When I was young, I needed a credit card. I went to the teller. Then I decided to move into a nice apartment with my girlfriend. I needed a mortgage, so spoke to the mortgage specialist. And then I said, I want to build a startup, which I did at IBM both. So I said, I need a loan. He said, oh, Paolo, risky, to the credit risk officer. It went very well, and I said, talk to the private banker, right? every time a different person, a different KYC, a different process, it makes no bloody sense. So the concept here is that the client is only one. So there should be no pay tech, credit tech, wealth tech, insure tech. There should be only client tech. Now, the history of internet has showed that ultimately only platforms make it happen and win. What is LinkedIn? LinkedIn is the platform for my professional life. I will invite you to chase me on LinkedIn after this presentation. Facebook is the platform for my personal life. You can also join me there. Amazon is the platform where you buy my books. Please do that. Twitter is the platform for my Trump paranoia. But where is the platform for my financial life? Unfortunately, today we don't have time to discuss it, but if you follow me on LinkedIn, you will see what my story goes into. But if we will find the unicorn 10 years, 15 years from now, that will be that platform, that fintech, that big tech, that bank, whatever, that can create the platform for the financial life of an individual, open bracket, his family, because we are our relationships, we are not just alone, or a small, medium enterprise. No time to discuss today, but I will engage you afterwards to tell you where we can start this happening and to be created. Now, what matters to me is the following. You know this one is Jeff Bezos, okay? So there is a misunderstanding of the platformification in financial services. I just published an article on the American Banker called US Banks Play Catch Up with the Chinese Big Tech. The subtitle would be Lose the Battle of Volumes, Win the War on Value. Because you see there's a misunderstanding again of what platforms can do. When I talk to the boards of Chinese banks, they get the point. When I talk to the boards of European or North American banks, they typically don't get the point. So I want you to understand what happens here. In the 1990s, and you remember because again, you're older than me, Amazon was only selling books, okay? Books, not much, no more, books. So on 60 Minutes, the journalist in American TV asked Jeff Bezos, what's Amazon? We're in the 1990s, I think 1992. He said, Amazon is not a distribution channel of books on the internet. Now, is a bank, is a fintech, a distribution channel of products on digital? That's the question. So he said, Jeff Bezos, let me explain to you. The publisher is sending me letters today complaining, saying that I don't understand marketing because I allow the users of Amazon to write negative and positive reviews, right? But if I would write only positive reviews, they say, we would sell more. So they say, it's marketing stupid. And then with his eyes, he goes, I'm not stupid, because, right? They don't understand. And he explains, they don't understand because they are not my client, and I'm not a distribution channel of products on the internet. My role is to advise my client on which is the best book to buy, because if they don't understand that, the initial motivation, they will not move forward. I have them on the platform, but I don't make transactions. So how do I do that? I put positive and negative reviews, because this way they can start trusting the platform. And when they build the trust, I can put more products. I can use different analytics in order to optimize the relationship. So that's another mistake. A lot of people focus on the idea that it's all about marketing. Data, AI is about understanding the client to do marketing with them, and they forget this is banking, this is not e-commerce, it's KYC, it's MiFID II, it's the PRIPS, it's a lot of regulation. And even Jeff Bezos understood that first of all, he had to take care of the client motivation. So that is the digitization of knowledge, making sure that the clients feel comfortable in being self-directed to operate fully on digital. Otherwise, we will not be capable of digitized banking. Now, I was sitting with Yves Perrier, the CEO of Amundi. Amundi is the 7th largest asset manager in the world. And again, last year at Paris FinTech Forum, we had the fireside chat. I asked Yves Perrier, knowing that we have all of these products and these solutions, can you tell me which is the product and the solution that justify the fees that the client has to pay to access these services? You know what he said? Yep, ladies.
And I think that the real value, which is brought either by banks or asset managers or life insurance companies, it's firstly a service of advice and permanent advice during the time of their investment.
Yes, the value
Okay?
question
So
is...
basically, he said not this product A or B. He said the relationship, that means a process of advice, of ongoing advice. So make sure whatever you do, that your digital platform, that your digital offer understands this element and can cooperate with others to create this element. Because this is the only way that clients would feel engaged and will use your solutions. Because you see what happens, these are the banks. We have bankers in this room. Okay, there you are. You are the shark, okay? But I love the sharks because I do scuba diving. And we have FinTech here. You are the piranhas, right? And honestly, I don't know if I want to swim with the piranhas or with the shark, but the point is that this is not the right picture. There has to be a competition, between banks and FinTech, because the real competition is the one of the big tech companies, Google opening account with Citibank, and financial having a larger market capitalizations of Goldman Sachs. Because if you want to play volume, there's no way you can be that volume business. If we discuss hyper volumes in the Western world, in China, they already have Uber volumes. So the only way to survive and to stay relevant and to do good for you, your customers, is to understand how to create value. So the goal cannot be for FinTech and banks to build disruptive innovation, but to understand the journey towards sustaining innovation to differentiate. Now, I'm really at the end of my presentation. I travel continuously in the world for IBM, and I can say that we can divide the world into 3 macro areas. The US is where technology was born, still is born, even though the Chinese are very aggressive. Europe is where regulation is born. We need it in order to create a common playing field. The capital markets union is also important. But China is the champion of FinTech because that is where the business model is born. So my role here with you is to understand the variety of different business models, see how technology can be plugged in order to scale it up, and make sure they're part of a regulatory framework so that it doesn't fire back like Libra, but creates opportunity for the entrepreneur and for its community. I'm really concluding here. This is Ginny Rometti, the CEO of IBM, and last year, at the Las Vegas conference thing, she had on stage Dave McKay. Dave McKay is the CEO of Royal Bank of Canada. She asked Dave a very simple question. She asked, what is the value of digital? Hear what he said.
Trying to create value not only for customers, but for our employees who serve those customers, bringing mobility, bringing advice, bringing insight into data, knowledge, value. And that's the equation that we're trying to...
Knowledge is value, and that's the equation. The reason why he's a CEO is because it took him 6 seconds. It took me half an hour to explain that. So the scope of the digital process is the digitization of knowledge to scale the competence. The competence of the people, they need to be more self-directed, therefore motivated to act on financial services, which is not e-commerce. The competence of the bankers, they need to reskill in order to provide better services to the clients in a hybrid model until artificial intelligence, if or when, will become deeply and truly conversational to flip the pull and push mechanism. You find the QR code of my LinkedIn profile here. If you're very modern, you can take a picture so that you can go on LinkedIn and we get connected. If you don't do that, it's not because you're not modern, but because we're already connected, right? Thanks for the time you dedicated to this presentation.